Welcome to the Graduate Financial Education Seminar on Investing. My name is Kristen Short. I'm a second-year PhD student in financial planning, and my assistantship is with the graduate school with the Graduate Financial Education Program. And the whole purpose of this program is to provide financial education for graduate students in an effort to help increase financial literacy and financial knowledge in order to decrease stress around finances. The research shows that graduate students are stressed in many different ways, one of which is feeling stress about finances. So the whole hope with this program is just to provide some of those resources and education that graduate students need in order to help reduce some of the stress that comes with being a graduate student. So to get started today, I just want to talk a little bit first about retirement. So there will come a time when you are no longer able to work or no longer wish to work for pay, and yet you will still need money to live. So where will that money come from? Well, there's this concept called the life cycle hypothesis. And if you look at this graph, you'll see the black curve that represents your income over time. And you'll see that in the early years, your income is very low when you're in school. And then after you've gotten out of school, your income kind of increases to midlife. And then in the final years, as you're approaching retirement or in retirement, that income kind of decreases. And yet, at the same time, our need for consumption, or what we require to live, remains somewhat constant throughout our lives. So you'll see that blue line across the middle that represents consumption. So if you look at kind of the intersection of our consumption needs and our fluctuating income throughout our life, you notice this yellow section to the left that represents a season of life where we spend time borrowing, right? So we borrow to go to school, to invest in ourselves. We're not making a lot of income, but we're increasing our earning potential. So a lot of us as graduate students find ourselves in that yellow section. That can be a discouraging place to be, but take comfort because the green section is upcoming. So that green section you see represents a phase of life where our income exceeds what our consumption needs are. And so we can use that excess income in order to repay debt that we had to borrow during that yellow section, and then also to save for what's upcoming in the red section. So then that final red section represents a period of time of our lives when we're dis-saving or when we're in retirement. And that's a time when we're basically spending down our savings or spending down our assets in order to meet our consumption needs because our income is either absent or decreasing. So there's various sources of retirement income: Social Security, employer-sponsored plans, individual retirement accounts or IRAs, and then kind of miscellaneous sources such as brokerage accounts or passive income or insurance, annuities, maybe real estate, rental income, that kind of thing. So Social Security is kind of the foundational source of retirement income, and throughout your life, whenever you get a paycheck from your employer, you pay a Social Security tax that pays into the Social Security system, and then based on the amount of money that you've paid in throughout your lifetime, you receive a monthly benefit once you retire, and you receive that Social Security payment every single month until you pass away. So you can see what your estimated benefit is for retirement by going to that website there, and that estimate will kind of update as you work more and your earnings change, and it kind of has a formula that factors in different earning years and stuff like that. So you can actually check that out and see what your estimated benefit is in terms of Social Security. And then second would be those employer-sponsored plans. So that would refer to any pension plan that you have, whether that's the TRS plan through the state of Georgia or some other pension plan that your employer offers, or what's more common these days are contribution plans. So 401k, 401a, 403b, 457b, these are all different types of contribution tax advantage retirement plans. And if you want to know a little bit more about what each of those plans are, I recommend you check out our seminar on employee benefits. So I'm not going to actually go into depth about those plans today, but you can access that information on the employee benefits presentation. And then individual retirement accounts are tax advantage retirement accounts that aren't offered through an employer, but you can just open on your own, and you can get it in a traditional format or a Roth format. And that just is a difference about when the taxes are taken out of the money that you contribute. And the contribution limit for that in 2019 is $6,000. So one of the challenging components of retirement is figuring out what that number is, that retirement nest egg is that you need by the time that you retire. And unfortunately, that number is not easy to calculate. Why? Because there's a lot of factors that impact our ability to accumulate money, and we can't always predict how those factors are going to play out in the amount of time that we need to save for retirement. So first of all, there's uncertainty about the age in which you will retire. So you may think that you're going to retire at age 65, but then let's say you're age 60 and you're really slowing down and you don't think you can work anymore, and so you decide to retire early, right? So because we don't know exactly when we're going to retire, we don't know how long we're going to have for the money we're saving to grow and accumulate. Number two, there's uncertainty about how long we'll live after we retire. So you may think you're going to live to age 85, but what happens if you live to age 95, right? That's an extra 10 years of income that your retirement nest egg has to be able to fund, and nobody knows how long they're going to live after they retire. And so that introduces some uncertainty about how much we need to save. Three, there's uncertainty about inflation rates over time. So that's basically the concept of how far your dollar will go, how much product you can get for the same price that you could get it today. So, a Coca-Cola might cost $1.50 today, but 20 years from now, it might cost $4, right? And so we don't know how much the prices of products are going to inflate over time. And so it makes it difficult to estimate how much we'll actually need annually in order to fund a similar standard of living that we have currently. And then finally, there's uncertainty about the investment returns that you're going to get on your money over time. So we know, generally speaking, if you invest in a stock market portfolio with some bonds, maybe you'll get on average a 7% return over 20 years. But that could instead end up being an 8% return over 20 years, or that could instead end up being a 6% return over 20 years. And just a difference of 1% return on average every single year for 20 years can make a big difference in terms of how much money you're able to accumulate. So because of these things, it's very difficult to predict exactly how much money you need to be saving each year and exactly how much money you need to have at the time that you retire. So how do we deal with this uncertainty? Well, the best option, honestly, is just to work with a financial planner, because they have resources and tools at their disposal that can help them model the impact of things like inflation and investment returns and unpredictable life expectancy and retiring at different ages. And they can use these models and softwares to help predict what the probability of success is based on the amount you're currently saving, or can help you figure out how much you need to save in order to achieve a certain level or probability of success in retirement. Now, if that's not an option, or maybe you're not at the age where you're ready to invest in a financial planner, like you've just graduated from grad school and you're just trying to, get your footing before you invest in something like that, then some alternate options could be, number one, to use milestones or benchmarks to see whether or not you're on track with your retirement saving. So this chart just gives an idea of the multiple of your income that you need to have saved by different age milestones based on the amount of income you earn on an annual basis. So for example, if you earn $50,000 a year, by the time you turn 35, you should have at least 0.9 of 50,000. So, almost 50,000 or $45,000 saved toward retirement in order to be on track for retirement. And by the time you reach age 45, you should have 2.5 times 50,000. So 125,000 saved by the time you're 45, all the way up until you reach retirement age, which in this chart is predicting around age 65. So by the time you're 65, if you're earning $50,000 a year, you would need to have 8 times your salary saved in order to have a financially secure retirement, right? So you need to have about $400,000 saved by retirement. Now notice that as your income increases, the number of multiples that you need to save of your income and have in that retirement nest egg actually increases, right? So if you're earning $150,000 a year, you have to have 13 times your income by retirement in order to have a financially secure retirement, compared to $50,000, which only needed 8 times your income, right? And then even further, if you earn $300,000 a year, you need to have 16 times your income in order to have a financially secure retirement and maintain your standard of living. So the reason for this is just that as your income increases, the portion of your income that gets replaced by Social Security in retirement decreases. So the lower income you are, the greater replacement value Social Security benefits will have in your retirement years. So maybe Social Security will replace 60% of your normal income. Whereas if you're higher income, the Social Security benefit gets capped at a certain amount. And so the amount of Social Security money that you're receiving in retirement may only replace 15% of your income or 10% of your income. And so in order to maintain that same standard of living, you have to have accumulated your own funds up and above beyond Social Security in order to maintain that standard of living. So another method that you can use if you don't want to use these benchmarks, or maybe if you want to use this in conjunction with these benchmarks, is that you can also use kind of a percentage rule. So the general recommendation is that you save 10 to 15% of your income. So you can just start out saving 10 to 15% of your income when you graduate. The older you are, the more you'd want to kind of lean towards that 15%. If you haven't started saving for retirement yet and you're kind of having to play catch up, then you'd want to save 15%, but generally 10 to 15% of your income is a good rule. All right, so let's talk about investing. It's not enough just to save for retirement. It's not enough just to put it in a savings account. It's very important that the money that you're putting into these savings accounts, these employer-sponsored plans, these IRAs, is actually invested in something. So what is investing? Investing is expending money with the expectation of achieving a profit or material result by putting it into financial schemes, shares, or property, or by using it to develop a commercial venture. So that's kind of a complicated definition, but what I want to point out are 3 things. 1, expending money. When it comes to investing, it takes money to make money. So a lot of us are ingrained with this concept that the way we make money is by performing labor, right? We put in work, we put in time, and we get money in return. When it comes to investing, you're not putting in your work, you're putting in your money. And the money itself is actually what's generating income or generating returns. You're basically putting your money to work. So you actually have to spend money or invest money, put money in order to grow it, in order to invest, in order to achieve a profit. So it takes money to make money. Number 2, expectation. All investing carries some amount of risk, and yet there is an expectation that your money will grow with investing, right? So it doesn't say with the guarantee of achieving a profit, right? There's risk associated, but it also doesn't say with the hope of achieving a profit, right? Like there's a legitimate expectation that by investing, you will achieve a profit. And then with that achieving profit, good investing should yield a net gain, right? So whenever we get too short-minded or short-focused, we can think we're yielding gains with our investings, but if we step back and look at the big picture and look at our investing behavior over time, that may not be the case. And so I'll have an example about that later, but good investing should yield a positive net gain. So why is investing important? Number one, it mitigates inflation risk, right? So we talked about this concept of products becoming more expensive over time. So that Coca-Cola that costs $1.50 today could cost $4 tomorrow, right? So let's say that you wanted to save money today to ensure that you would be able to purchase a Coca-Cola in 20 years. And so you put your $1.50 in a savings account and you wait 20 years and you go to buy that Coca-Cola and uh-oh, you only have $1.50 saved, but the Coca-Cola actually costs $4, right? So without investing, you actually lose value on your money. You are at a loss because of inflation. So by investing and growing our money, we mitigate that inflation risk because we can grow that $1.50 to $4, $5, $6, $7 in 20 years, and not only be able to buy the Coke, but be able to buy the Coke and more. And then secondly, investing is important because it takes advantage of the concept of compounding. And so as we grow our money on an annual basis, that 7% return on $100 may not seem like very much today, but then that cumulative balance grows at 7% the next year, and the next year, and the next year, and the growth on that becomes exponential. It's not linear. So let's just take a look at an example here. So let's say you have this graph, and the red line on this graph represents saving $5,000 every year for 30 years, right? So if you were to save $5,000 every year for 30 years, you would end up with $300,000. The blue line represents saving $5,000 a year and investing it for an average return of 8%. So you'll notice that that blue line grows exponentially, so that after the end of 30 years, you've actually accumulated nearly $600,000 on your money. The green line represents saving $5,000 a year at an 8% return, but delaying the start of that saving by 5 years compared to the blue line, right? So you start at 0 5 years in, and then you start the same pattern as the blue line. So if you look towards the left side of the graph, the difference between the green line and the blue line may not seem like that big of a difference. It may not seem like 5 years of waiting without any saving would make that much of a difference in the long run. But if you look to the right side of the graph, the difference of where the blue line ends up versus the green line ends up, the blue line's at, $575,000 and the green line's at $375,000. So you have about a $200,000 difference between the outcome of those two different lines just by delaying retirement saving by 5 years, right? So starting early really, really matters because of that concept of compounding. So a lot of graduate students would see this graph and feel very discouraged. Why? Because a lot of us are spending our time in graduate school, we're not saving for retirement, and we're going to have basically the story of that green line, right? Waiting year after year after year to begin starting to save for retirement because we're in grad school and we can't afford it. And so it can be discouraging to look at a graph like this and think, wow, I'm going to be so far behind on my retirement savings. But let me show you this. So here's another graph. And on this graph, we have the same red, blue, and green lines, but I've added an additional line. And that yellow line represents the same 5-year delay as the green line, the same 8% return as the blue line and the green line. The only difference is with the yellow line, instead of contributing $5,000 a year, you contribute $8,000 a year. All right, so you play catch up. So you start 5 years late, you contribute $8,000 a year at an 8% return, and you'll see that that yellow line gains ground on the blue line. And by the end of year 30, it actually surpasses the blue line. So you might be thinking, well, that's great. I can catch up, but I have to contribute $8,000 a year, and Blue Line only has to contribute $5,000 a year. So that's not fair. How could that be worth it for grad school? Well, if you think about it, going to grad school is going to increase your salary. I could almost guarantee you with 100% certainty that graduate school, earning a master's degree or earning a PhD, will increase your annual salary by more than $3,000 a year, right? In some cases, it's going to increase your annual salary by $10,000 a year, $20,000 a year, maybe $50,000 a year. In some professional programs like medical school or law school or vet school, like the increase in salary potential could be $100,000 a year. So the fact that you have to contribute a little bit extra to your savings each year as you would have had to if you didn't go to grad school, it's not a problem because your income is going to increase. And by contributing that $8,000 a year, you're actually going to end up surpassing the blue line, right? So this can bring some comfort knowing that your time in graduate school is worth it because you're increasing your lifetime earnings and your capacity to save more toward retirement, and you will be able to actually play that catch-up game. So let's talk a little bit about types of investments and specifically securities. What is a security? A security is a tradable, negotiable financial instrument that holds some type of monetary value. So there's two main types of securities. Debts and equities, or what you might be more familiar with hearing, is bonds and stocks. So bonds represent money that's borrowed and repaid with interest. We're familiar with this because a lot of us have either credit cards or student loans or car loans or a mortgage, and we're familiar with this concept of when money is borrowed, that money is repaid with interest, except for usually we're the borrower. When it comes to bonds, we're the lender. All right, so the way it works is you basically purchase a bond, and in purchasing that bond, you're lending money to the government. And let's say the length of that bond is 10 years. So over the course of 10 years, the government pays interest to you each year for that money that they've borrowed from you. And then at the end of the 10 years, the government returns the principal or the initial amount that you gave them. And so you walk away with your initial amount of money plus all the interest that they paid you, right? So you walk out ahead. And then stocks represent ownership interests in an entity such as a company. So a lot of us are a little bit more familiar with stocks. So this would be like owning a stock of Apple or one share of stock in Amazon. By owning that share, you are a literal part owner in the business, right? Like you have one unit of ownership in that company. And as the value of that company increases and decreases, the value of that stock increases and decreases, the value of the stock that you're holding increases or decreases, right? And so if the stock increases and you sell it, then that's how you make your money. So the big thing about securities, what makes stocks and bonds securities, is the fact that they are tradable. They're tradable in the market. So how are bonds traded, or how are debt securities traded? Basically, when it comes to bonds, the trade value of a bond comes from its interest rate. So you have this scenario, you lend money to the government for 10 years, the government pays you interest each year, and then at the end they return their principal. So let's just say you purchased a bond for $10,000, and let's say the interest rate on that bond contract was 4%. Every year, the government would pay you 4% of $10,000, so every year you would get $400 for 10 years. Over 10 years, you'd earn $4,000 of interest. Then at the end of the 10 years, they'd give you back the $10,000 you paid at the beginning. So you'd have a total of $14,000 in your pocket. for a gain of $4,000. Now, let's say you bought a $10,000 bond at 4% interest, and you were locked into that interest rate. And then let's say the very next day, interest rates on bonds dropped to 1%. So anybody who wanted to buy a new bond would only get a contract for 1% interest from the government. So if someone were to purchase one of those bonds, they'd pay $10,000. They'd get 1% interest or $100 every year for 10 years for a total of $1,000 in interest. At the end of the 10 years, they'd get the $10,000 back for a total of $11,000 in their pocket at the end, and that's a gain of $1,000, right? So new bonds at 1% are basically worth a gain of $1,000, whereas the bond that you purchased a day ago, when the interest rates are higher, is worth a gain of $4,000. So if someone is wanting to purchase a bond and the interest rates have just dropped to 1%, instead of buying a new bond, it would be smarter for that person instead to go to you and say, hey, I want to buy your bond from you because your bond is a contract for 4%, and the bond I can buy in the market will only give me 1%. So they say, hey, I know you just purchased that bond for $10,000, but I will pay you $12,000 to have your bond contract. So this is a good gig for you because you just paid $10,000 for your bond. They're going to pay you $12,000 to buy it off of you. So you get an immediate gain of $2,000, right? Yeah, it's less than the $4,000 you would get if you kept the bond, but you have to wait 10 years in order to get that gain of $4,000. Whereas this person's offering you an immediate gain of $2,000, right? So you're willing to take that deal. And then for them, yeah, they have to pay $12,000 to get the bond from you rather than the $10,000 they could pay to get a new bond in the market. But if they have your bond, they're going to get 10 years of 4% interest, right? So they're going to get $4,000 over the course of 10 years. At the end of 10 years, the principal is going to be returned to them that you initially paid to the government. So they're going to have $14,000 in their pocket, and they paid you $12,000 to get it from you. So they have a gain of $2,000. So even though they kind of overpaid for the bond on the front end, it was worth it to pay for your bond and get a gain of $2,000 rather than to buy a new bond at $10,000 and only have a gain of $1,000, right? So as interest rates rise and fall in the market, it changes the value of the existing bonds because it makes them more or less desirable based on whether their interest rates are higher than what new bonds are selling for, or if their interest rates are lower than what new bonds are going for. So kind of the general rule of thumb is that as interest rates fall in the market, the value of bonds currently in the market go up, and as interest rates rise in the market, then the value of bonds that have already been purchased in the market decrease because they're not as valuable as new bonds that can be purchased at the higher rate. All right, and then equity securities are that stock kind of trading value that we talked about a few slides ago. So how are stocks or equity securities coming into play? Well, to start out with, businesses have inherent value. And whenever a business starts out, it starts out as private, but it has kind of this unspoken or undefined value based on things like what it owns. So maybe the equipment it has, the inventory it has, if it owns property, and then how much revenue it brings in kind of determines its value, and what kind of technology it owns the rights to, like patents or copyrights. And so businesses have kind of this value that are inherent to them, but it's not easy to actually cash out or put a number to, right? So let's say the owners of a private business, let's say their business kind of has this inherent value of $1 million. Let's say the owners want to cash out $100,000 of their $1 million value business. Well, can't just sell $100,000 worth of equipment because then they wouldn't have the equipment to run their business anymore, right? So it's not easy for business owners to cash out value of their businesses. If they want to do that, they have one of two options. Number one, they can sell the whole business to somebody else so they can get acquired. So someone else can come along and say, hey, I think you have a great business going on. I'll buy it from you for $1 million. Then the current owners get $1 million cash in their pocket, and the other person walks away with the business. But a lot of business owners don't want to do that, obviously, because then they lose their business. So a second option is that they can sell pieces of ownership to somebody else. And this is the process of taking a business public, so taking it from private to public. And this going public process is the process of basically creating shares of stock in the business. So whenever a company decides that it wants to go public, it kind of goes through this fundraising phase of going to different investment banks and raising money, and the investment banks kind of say, hey, we think you're worth X amount of dollars, so we're going to give you, maybe $1 million, and we want 20% ownership in the company. And another investment bank comes along and they say, okay, we'll buy in also, so we'll give you $2 million for 40% ownership in the company. And there's kind of this negotiating process, and at the end of it, they figure out, okay, this is the amount we think the business is worth overall. Here's how much ownership the owners are keeping. Here's how much ownership is going to these different investment banks. And then those investment banks split their ownership into little pieces called shares or shares of stock. And then those shares then get resold to large investment groups who then resell on the public market to the public. So it's kind of this process of naming the value of the company through raising funds through investment banks, and then splitting up that ownership into small units so that the general public can purchase those units and have part ownership in the company. So whenever we talk about bonds being tradable or shares of stock being tradable, where do these trades take place? They take place in the market, and a lot of people are kind of confused or intimidated by this concept of the market. So I just want you to think of a standard market, like a tangible fruit and vegetable market. When you go to a fruit and vegetable market, you exchange money or funds in order to get a product, a fruit, a vegetable. Well, the bond market and the stock market are no different, right? It's just a place where you can buy and sell different products, and those different products are either shares of stock, bonds, mutual funds, index funds, which we'll talk about. It's just a place where you can buy and sell. And so the market I'm referring to, looks a little more something like this, or at least it used to, with, people on the trading floor buying and selling, making trades. And in the past, stocks were actual literal certificates of stock. So when you owned a stock of Pepsi Cola company, you actually had a paper that said you had a certificate of stock. Or when you had a stock of Walt Disney company, you had a piece of paper that said you owned, a unit of stock. Well, now we just have online interfaces, right? In the same way that we have online banking, right? For our checking account, like we just log in and we see, okay, I have $100 in my checking account. Same with the market now. We buy and sell bonds and stocks and index funds and mutual funds just on an online portal. And as we buy and sell those things, we develop a portfolio. It might look something like this, that just have different names for the different funds or bonds or whatever it is that we own and their value, and we can kind of log in and track and see how those things are doing. So I just say this so that you don't get bogged down by this concept of the market. When you hear like, oh, the market's going up or the market's going down, or, I'm buying investments in the market. The market is just the entirety of securities that are available for purchase and sale, right? So it's all the stocks that are available for purchase and sale, all the bonds, all the mutual funds, all the hedge funds, all the real estate investments, all those different types of investments that you can purchase or sell make up this market. Now, prices in the financial markets vary and fluctuate, and so it can be a little confusing to people how those prices are determined, especially when it comes to stocks. So the prices of stocks, for example, are just based on speculation about whether or not a company is doing well or not, right? And there's kind of this supply and demand based on collective psychology. So if a lot of people think that a company is going to do really well in the future and the value of that company is going to be increasing, then they might start buying stocks of that company. And as more people start buying them, the demand increases, the supply decreases. There's kind of this collective psychology of like, oh, everybody's buying stock from Netflix or from Apple or whatever, and everybody else is buying it, so I should probably buy it. And so everybody starts buying it, and because everybody's buying, the price goes up. And then there's also on the flip side a similar mentality if people start thinking, okay, Apple just released a new product and we don't think it's doing very well, and we're not super hopeful about its future and where it's going, and so I'm going to sell some stocks here. And then people notice that other people are starting to sell their stocks, and so the supply starts increasing and the demand starts decreasing, and there's this collective psychology of like, oh no, everyone's selling their Apple stock. And so because of that, the price then drops. So it's not like Apple gets to go into the market portal online and say, okay, today we want our stock to be worth $300 and tomorrow we want our stock to be worth $500. No, like the prices of stocks are totally driven by what people, buyers, sellers are willing to pay to obtain a stock or willing to receive in order to sell stock. And those prices fluctuate based on the supply and demand. So let's talk a little bit about risk. And risk is the uncertainty around whether an investment will go up or down in value. And the higher risk a certain investment is, the greater potential return there is on that investment, but then also the greater potential loss. And then lower risk investments have lower potential return, but then also lower potential loss. So you can't lose as much with them. So different investments kind of rank on this pyramid, with things like cash, savings accounts, money market accounts being very low risk with low return and low potential loss, all the way up through government bonds, mutual funds, bonds, stocks, all the way up to collectibles, becoming more and more and more and more risky with higher potential return, but then also higher potential loss. So every person has a different level of tolerance for risk, and a lot of people are pretty loss averse, and so it can be challenging for them to think about taking on risk of investment because they think, yeah, well, there's a potential I could gain, but what if I lose all my money? And so because they're scared of losing their money, they decide, I'm just not going to invest at all. But even though risk tolerance varies from person to person, that doesn't mean that you shouldn't invest. I would argue that everyone should invest regardless of their risk tolerance, and in spite of their risk tolerance, they should invest, because investing is one of the only ways, if not the only way, that you're going to be able to accomplish your retirement saving goals. And so the best analogy I can think of to kind of help explain this concept of risk and the importance of investing is with the idea of driving. So driving is one of the riskiest things that any of us will do on a daily basis, right? There's so many people who on a daily basis get in car accidents, get severely injured in car accidents, who are killed in car accidents, and we all know that driving is a risky behavior. And yet almost everyone I know is willing to accept the risk of driving because they see the importance and the necessity of getting from point A to point B. And our society is heavily dependent on personal transportation or personal vehicle transportation in order to get to work, get to the grocery store, or whatever. And so even though it's a risky behavior, we do it because we realize the importance of it, and we take precautions to help reduce the risk around driving, right? So we wear a seatbelt, we drive the speed limit, we drive sober, we don't text and drive, we use our side view and rear view mirrors, right? So we take all these steps and these precautions to help reduce the risk around driving, and then that helps us to be able to utilize or take advantage of the benefits of driving without being so exposed to the risk of driving. So when it comes to investing, there are also ways that we can reduce our risk that allow us to make money and be confident about the retirement that we're saving toward. So number one, we reduce risk with investing by having an uncorrelated asset allocation. Number two, through low-cost diversification. And three, through goals-based time horizons. So we're going to kind of unpack these three methods that we use in investing to reduce risk. So number one, asset allocation. Asset allocation refers to the various types of assets that you own. And the reason why we want to have an uncorrelated or a mixture of assets is because different types of assets are affected by different economic forces, right? So we want to have an asset allocation that's made up of assets whose financial performance are uncorrelated with one another, okay? So like, let me give some examples. So stocks versus bonds. The prices of stocks are totally unrelated to the prices of bonds, because we talked about earlier, the prices or the value of bond is dependent on what the interest rates are doing, and the prices of stocks are based on the performance of the company whose stock it is, right? And so even if interest rates all of a sudden skyrocket and the prices of bonds fall, that change in value of bonds is going to have little impact on whether or not your Apple stock is doing well, or whether or not your Amazon stock is doing well, or whatever, right? So if you have both of those things in your portfolio, you have some stocks and you have some bonds, then loss in one area doesn't mean loss across your whole portfolio. Or another example would be US stocks versus international stocks. What's happening in the US stock market is largely unaffected by what's happening in the international stock market. And so if something plummets in the US stock market and you also have international stocks in your portfolio, then your whole portfolio isn't going to just be thrown to pieces when stock prices in the US go down, because you're going to have these international stocks that could be doing pretty well when US stocks aren't doing well. And then again, even stocks and bonds together, the way that they perform is highly uncorrelated to the way something like gold performs. And so having a little bit of gold in your portfolio can help reduce risk around losses associated with the stock and bond market. So there's all these different asset classes: large cap stocks, small cap stocks, international stocks, emerging stocks, and then different types of bonds like corporate bonds, high yield bonds, government bonds, international bonds. And then you have things like commodities or real estate investments, or TIPS, which is another type of government bond, or cash. And you want to hold a little bit of each of these different types of asset classes, because each one of them is impacted by different economic forces. And so loss in one area won't mean loss in all the other areas. So then we have diversification. And diversification refers to the number of different investments you hold within any given asset class. So why is diversification important? It's important because you can never predict the performance of any single investment, right? So if we were to have invested in Amazon years and years and years ago, that would have been a very good investment. If we were to have invested in Facebook a long time ago, that would have been a very good investment. But you couldn't necessarily say the same thing if you had decided to invest in Snapchat a while ago, or if you had decided to invest in Twitter a while ago, right? And so in any given moment, when we have the opportunity to invest in a single investment or a single company, there really is no certainty about how that company is going to perform, whether their stock's going to go up or down. And so, in order to kind of hedge that risk, we diversify. We hold a lot of different investments within each asset class. So looking back to that asset class chart, so like within the blue section, within the large cap stock section, we would hold a lot of different company stocks, large company stocks. And then within the small cap stocks, we'd hold a lot of different small company stocks. And then the international stocks section, we'd hold a lot of different international stocks, right? So within each of those colored bands, we're not just holding one type of investment, we're holding a lot of different types of investments so that even within each of those asset classes, we're highly diversified so that the loss of one company doesn't necessarily hurt us all that bad because we have other companies that could be doing super well. So diversification is accomplished many times through something called mutual funds. And the concept of a mutual fund is that instead of buying a lot of one company or one investment, you buy a little bit of a lot of different companies or a lot of different investments. So a mutual fund is an investment fund that's made up of a collection of individual investments. And the best way I can kind of describe this is this concept of taco seasoning. So let's say you had a recipe that called for a teaspoon of taco seasoning. You could go to the store and buy chili pepper and salt and black pepper and garlic, cumin, and paprika, and all these things, and you could pay for each of those individual seasonings, and you could come home and you could mix them all together, and then you could get your 1 teaspoon of taco seasoning, right? So that would be like you trying to pick out take a few shares of Apple, take a few shares of Amazon, take a few shares of Netflix, a few shares of Tesla, a few shares of this and that in order to kind of diversify my portfolio. And it would take a lot of effort and a lot of time and a lot of money to do that. Or to get your 1 teaspoon of taco seasoning, you could just go to the store and purchase a 30 cents packet of taco seasoning and come home and scoop a teaspoon out of it, and right then and there you would already have your full mix of taco seasoning without ever having to go and purchase individual ingredients for that seasoning. That is what mutual funds are. Instead of you having to go and purchase all these stocks from a bunch of different companies, you can just purchase one mutual fund, and by buying that mutual fund, you are getting little pieces of a ton of different companies, and so you're diversified even though you as the consumer are actually only purchasing one thing, right? So the advantages of a mutual fund is that they're more diversified than selecting single investments. They're cheaper than doing it yourself, right? Because in order to diversify yourself, you have to be able to come up with the money to buy at least one unit of stock from each company that you want to have in your portfolio, right? So whereas with a mutual fund, even if you only had $200, you could buy $200 worth of the mutual fund and have access to hundreds of companies. When purchasing a single stock of a company may cost $300. You might not even be able to purchase one unit of stock from a company with $200, whereas if you purchase a mutual fund, those $200 are being split across tons and tons and tons of different companies. The disadvantages of mutual funds, specifically actively managed funds, is that a lot of times there can be human error due to speculation. So the person that's creating the mutual fund, they may buy stocks from different companies to put into that mutual fund, and it's based on kind of like the performance that they think that company is going to have. And if that company doesn't have that level of performance, then the mutual fund could end up not doing as well as they think it will do. And there's kind of this person on the other side of the mutual fund that's making these investment decisions, and you're subject to those investment decisions because their decisions influence what companies are held within that mutual fund. And because there's a person behind the scenes doing this analysis and deciding what's going into it, and they're making trades and swapping stuff in and out, the operating expenses associated with mutual funds can be relatively high. So even if a mutual fund returns 8% this year, if you have an expense ratio on that mutual fund of 2%, then you're not really earning 8%, right? Because you're having to pay those costs just to own the mutual fund. And so your returns are what, only 6%? So the math isn't exactly that simplified, but the idea is if there's a cost associated with owning a mutual fund, then those costs directly eat away from the returns that you get from that fund. And then three, because there's that person who's kind of actively managing the investments within the fund, there's this high portfolio turnover rate of things being bought and sold. And every time something's bought or sold in a fund, there's transaction costs, and that again just kind of increases the costs associated with owning that fund. So the solution to this is something called index funds. And an index fund is a type of mutual fund with a portfolio that's constructed to match or track the components of a market index. So what is a market index? A market index is basically a list of companies that represent some segment of the market. So an example would be something like the S&P 500. So the S&P 500 represents the 500 largest companies, right? And so there's a list of what those 500 companies are based on their valuation, and that list kind of is what it is. So if you had an index fund that's modeled after or that tracks the S&P 500, then that fund would be made up of shares from those 500 different companies. And the way that fund would be constructed is for the companies that are the absolute largest or at the top of the list of that 500, they would have a greater weight within the fund. So you'd have a lot more stocks or a lot more units of the companies that are the largest. And then as you get kind of further and further down the list, the amount of holdings that you have in those lower companies on the 500 top list would be a little bit smaller and smaller and smaller and smaller and smaller and smaller. And so you'd have this index fund that has kind of a weighted holding of the top 500 companies. And by purchasing one unit of that S&P 500 index fund, you would be invested in the top 500 companies. So the advantages of index funds is that it gives you broad market exposure because you're being exposed basically to the 500 largest companies, or let's say it's based on the Russell 2000 index, the Russell 1000 index, then you'll have exposure to 1,000 companies or 2,000 companies. And then another advantage is that there's no human speculation involved. So there's not some fund manager deciding whether or not to put a company into the fund, because the S&P 500 just is what it is, right? Like it's a list of companies, and these are the companies that get put in, and there's no speculation about whether or not Microsoft should be in there or not be in there, because if they're on the list, then they go in the fund. And because there's not as much speculation involved, there's not as much turnover involved, the operating expenses on these funds are much lower. And so the expense ratios are much lower. And so the costs that you have to pay to own the fund are much lower and don't eat into your returns as much as actively managed funds would. And then, of course, there's low portfolio turnover because the top 500 companies doesn't change all that frequently. And so only when it does do the companies in the fund get changed in and out. All right, so we've talked about uncorrelated asset allocation. We've talked about low-cost diversification. The third strategy for reducing risk is investing based on a time horizon. So in any given 20-year period of time, the overall market has always increased. So even amidst the dot-com bubble burst, even amidst the Great Recession and these different periods of time when the stock market has decreased, if you look at any 20-year chunk of this chart, and this is inflation adjusted even, you will always see a positive gain. right? So even if you took the peak of year 2000 and went 20 years out, well, you can't see it on this chart, but if you were to go all the way to 2019 or 2020, you would see that the graph increased. The same could not be said of any given 5-year period, right? Because if you took the peak of 2000 and then you looked at the price of the market in 2005, right, you would have had a loss on your investments. So when you have a shorter time horizon, you have to be a little more conservative, not take as much risk in the way that you invest because, there's a lot more uncertainty in shorter time periods. Whereas if you have a long time horizon, 20 years, 25, 30 years, 40 years, you can take more of that risk and you can invest more in risky types of investments because you have time for these corrections to kind of play out. And so you can take advantage of the long-term growth of the market. So remember back when we were talking about the investing definition, and I said good investing should yield a net gain. I want to illustrate and talk about what I meant by that and why it is so detrimental for people to take money out of the market when the market goes down. So when we think about this idea of long-term returns, that concept of always having positive returns across any 20-year given period of time, that only works if you leave your money invested in the market and you don't pull it out when the market dips. All right, so let's walk through an example here. So let's say you had $100,000 to invest in the market back around 1980. And let's say the price of the S&P 500 at that time was $370. With your $100,000, you would have been able to purchase about 270 shares. If you were to sell those 270 shares today for $2,900, you would have had a gain of $683,000, and that's inflation adjusted. Now, let's say you weren't so lucky to invest way back when the prices were that low in 1980. Let's say instead you entered the stock market around 1999 or 2000 when it was kind of reaching its peak, and at that point in time you were able to invest $100,000. And let's say the price of the S&P 500 at that point in time was $2,200 per share. You would have been able to get 45 shares. Well, if you were to hold on to that investment and sell it today, you would have been able to sell those 45 shares for $2,900, and you would have gotten a gain of about $30,500. Now let's say you invested that $100,000 around year 2000, and then in 2008, the Great Recession hits, and you freak out. You think, I'm losing all my money. I want to stop the bleeding here. I'm just going to get out of this mess. And so you take those 45 shares, you cut your losses, you sell them all at a low price of $873 per share, and you salvage or save $39,285, about $40,000 you save from loss. All right, so you lost basically $60,000 and you cashed out at $40,000. And let's say then over the next couple years, you kind of wait to see what's happening in the market. It's kind of increasing a little bit, it's doing better, it's recovering, and you kind of build up your confidence and your stamina again, and you're thinking, okay, I think I can enter back into the market. So a few years later, you decide, all right, I'm going to put that money back in. So you take that $39,285 and you buy back in when the shares are about $2,200 per share. And so because you don't have as much to work with, you walk away with only 18 shares. All right, so now you got 18 shares of S&P 500 stock. If you were to sell those shares today, those 18 shares at $2,900, you would get out $52,200, right? So you might look at that and you think, all right, I invested 39,000, I got out 52,000, so I had a gain of $12,915, right? Well, actually, no. Actually, by selling out during the recession when prices were low and buying back in once the prices had increased again, you actually cheated yourself out of those gains. And overall, since the initial $100,000 that you invested back in 1999, 2000, you actually incurred a $47,800 loss, right? You invested $100,000 back in 2000, and today you only walk away with $52,200, right? You lost $47,800. So if you're short term focused and you just look, okay, I bought in here and I sold here, you might think that you gained. But from here to here, which should have been a $30,000 gain, actually became a $47,000 loss because of what you did here. So the whole point of this slide is just to say that yes, long-term returns have historically been there over long periods of time, but only if you stay invested in the market. Gotta buy and hold and ride out those downturns, because if you can ride them out, then when the market corrects itself and grows and increases over time, you can still have that overall net gain. So this kind of fuels the conversation of managing risk over time. So whenever you have a long-term goal like saving for retirement or you're young, you can tolerate more risk with your investments because there's time for the bumps and the corrections to play out. And you can think more about growing your money rather than protecting your money. But when you have a short-term goal or you're older or closer to retirement, you can't tolerate as much risk because you don't have time to recover from the bumps and the corrections in the market. And so at this point, you should be thinking about protecting your funds rather than growing your funds. And so your portfolio allocation should reflect the time horizon that you have and whether you're working towards a long-term goal or a short-term goal. And so here's kind of a variety of portfolio allocations that are possible. And so you'll see on the right here, an aggressive growth portfolio could have, 85% stocks, 15% bonds. That could be as much as 90% stocks and 10% bonds if you're really young and retirement is far away and you have a lot of time for corrections to kind of play out. And then as you approach retirement, you might start shifting some of those stocks into bonds and cash. So here you'll see about 70% stocks and about 30% bonds and cash. And then from there to more of a balanced portfolio of about 50% stocks and 50% bonds and cash, all the way to a conservative portfolio that you would have more in your retirement years, especially in your late retirement years, where you have as much as 80% in bonds or cash and only 20% in stocks. So how can you start with investing? Number one, first step is to open an account. If you have access to an employer-sponsored plan, like a 401k or 403b or 457b, then that's where you should start, because a lot of times employers have matching programs where they'll also contribute funds into those accounts, and so you should take advantage of that extra funding that you can get from your employers. If you don't have an employer-sponsored plan, then the next step would be to look at an IRA or an individual retirement account, and you can open either a Roth IRA or a traditional IRA. And then if you've maxed that out, then the third option could be to open just a normal taxable brokerage account. And once you have an account open, whether it's an employer-sponsored plan, an IRA, or a brokerage account, you want to go ahead and put money in on a regular basis. But just know that just because you've put money into a 401k or just because you've put money into an IRA doesn't mean that it's automatically invested, right? It could be that that money is just sitting there in cash. You actually have to go in and you have to invest the money. So when you do that, you should invest the money in a range of assets. Remember, we talked about the uncorrelated asset allocation with high diversification. So we talked about that at a low cost. How can you go about doing that? One, you can work with a fee-only financial planner who uses index funds and who can help you pick out the portfolio that best meets your retirement goals, your time horizon, and is going to help you find funds that are low cost and have that diversification. Or if you're not ready to work with a financial planner, another option is that you can use what are called target age mutual funds. And so what these are just a single fund that is labeled according to your target retirement date. So let's say you plan to retire in year 2060, you would pick the target age fund that's named the 2060 target date fund, and that fund is going to be constructed with an asset allocation and a portfolio allocation that matches the amount of risk you should be taking based on how far that retirement date is from now. So if that retirement date is 20 years from now, then that fund is going to consist a lot more of stocks than it does of bonds. And then as that date approaches, the fund will automatically rebalance itself to become more and more conservative based on that retirement date. So this is a really easy way for you to be invested based on the appropriate time horizon, and that fund is going to have a range of asset allocation, and it's going to be highly diversified because it's going to use mutual funds or index funds within it. And so you can accomplish those different goals just by putting all your money into that one fund. The only drawback with target age mutual funds is that they can sometimes have slightly higher costs associated with them, and they also sometimes don't have the best funds available to you as an investor in that target date fund. So a third option, if you don't feel ready to work with a financial planner and you don't like the idea of having to pay a little extra costs for a target date fund, then a third option would be to just pick one total market stock ETF, such as VTI or SCHB or ITOT, and one total bond market ETF like BND or AGG or SCHZ, and just allocate your portfolio based on your risk or your time horizon with each of those funds. So that's a very simplified way of investing, and it's not going to be as effective as working with a financial planner who can build a little bit more of a complex portfolio for you, but it would be a fine place to start if you weren't ready to work with a planner yet. Where should you go when it comes to opening that account or getting those investments or getting started with this whole process? Really, it doesn't matter a whole lot, but I would just encourage you to shop around with different companies. So each of these different companies, Fidelity, Vanguard, Charles Schwab, TD Ameritrade, they're all going to offer options for opening an IRA, right? And they're all going to offer some sort of total stock market fund or total bond market fund. I would just recommend going to each of their websites and finding out, okay, what does it take to open a Roth IRA at Vanguard versus Charles Schwab? And are there any fees for opening the account there? Do I have to have a minimum balance in order to open an account? If I open an account there, am I going to have access to funds other than Vanguard funds or other than Charles Schwab funds? So these are kind of some questions that you might want to think about. You can even Google search, what is the best company to open a Roth IRA with? And you'll find a variety of websites that help you kind of think through the different things that you should be considering. But really, any one of these companies would be considered very reputable and are going to have options for you. So it doesn't really matter where you go. The whole point is that you just take that step and you go ahead and you open the account and you start contributing those funds and you start investing the funds. So this sums up everything I have for you about retirement and investing. If you have any questions regarding these topics, you can reach out to the Graduate Financial Education Program. The email address is listed there, gradfineduc@uga.edu. And if you're a student on campus at UGA in Athens, then you have access to the Aspire Clinic. And this is just a free clinic on campus that offers one-on-one financial counseling. And so you can meet with someone to talk about questions about employer-sponsored plans or opening an IRA or different things like this. And that is accessible to you and a resource for you. And so I encourage you to take advantage of that.